Hi, this is Drew Tignanelli. This is our February Pulse update. And right now, I've got Christopher John O'Shea, the Chief Investment Officer of the company. He gave a great update earlier about a week ago from when you're going to get this Pulse video. But we thought we would just start off talking about the markets. Chris,
Morning, sir.
People tend to like when the markets go up. It's a lot more fun.
Without a doubt. And it takes a longer period of time, so the enjoyment gets spread out, but the pain and the discomfort happens rapidly.
In today's world, it seems like it has accelerated tremendously.
Right, sure.
With computerized trading, short sellers, a lot of people don't understand how short sellers really make money, but when they get a down market, they try to keep pushing that momentum down so that they can unload their short sales and make a lot of money. And it's one reason why politicians get so mad at short sellers, is because it's sort of artificial market movements, but it's a necessary part of the monster. It's just how it works.
Sure. Yeah. When we're saying that, we're not making light, we're making light of it in the context of the longer term, because that's what happens in short-term markets. Things will be all over the place because there's a certain amount of activity, and it doesn't take a lot of the bulls or bears to come in a rush to really put markets in a certain direction. But that noise, we see it, but we try to look beyond it to the longer term.
Sure. And unless there is negative momentum in the market, short sellers aren't going to be successful. And matter of fact, when the short sellers get caught and the momentum turns back to the positive, that's when the market actually does its best. Right. It's like the meme stocks, these stocks that people were trading like GameStop and AMC, when they went up ridiculous amounts of money. Well, that was because there were these short sellers who were selling the stock and have to buy it back. That's what, maybe we're talking about short sellers like everybody knows what we're talking about.
Right.
And so we have to be careful about that, because probably most people don't know. So why don't you give them a little, or I'll do it, whichever you prefer.
Well, sure. Well, yeah, I mean, either way, but just to touch on it though, the sentiment though, because of the last 3 weeks, sentiment, especially for the individual investor, has turned negative. So that's a healthy thing, because for longest of time, everyone's just felt that stocks just go up the last 3 years, but short sellers. So when you put all stocks now are in street name, people don't own certificates anymore. So they give them to the brokers. Brokers have them. They lend them out to people who don't own them, but want to sell. So you want to buy high and buy low and sell high. And so the short sellers just reverse that. They're looking to sell at a high point, hoping that stocks are going to go down. So they have to borrow shares from the brokers, and then they sell them, and then they hope to buy back down at a lower price. But what has to happen between that? Stocks have to go lower.
Right. Now, here's the fascinating thing with that, Chris, that our clients need to know, is that when you buy a stock hoping it's going higher, okay, you have a limited risk of what you paid on the stock, right? So if I put $10,000 into Apple thinking it's going higher, the worst that can happen to me is I lose my $10,000. Right. But if I sell Apple at $10,000 of Apple that I borrowed from somebody else, hoping it's going lower, and Apple goes up to 200 to 400 to 1,000 to 2,000 to 20,000, I have an unlimited risk of losing money. Unlimited, Chris. And that's why short sellers tend to move really quick, like roaches. Kind of like roaches.
What do you think of short sellers really, Drew?
Right. Well, I mean, I just want to point out that short sellers are necessary, because we've said it before. If markets don't go down, they'll never go up. That's an important point to understand. A CD never goes down in value. but it only goes up a teeny bit at a time because there's no volatility. And it's important that investors understand that volatility is critical. If you want the upside, you must accept a certain portion of downside. It's logical.
Right. And so, back from 66 to 82, we've looked at history in the past. At, August of 82, the start of the biggest bull market in history, nobody wanted to buy stocks. Nobody wanted to. Short-term rates were, 19, 20% in a money market. Why would you ever buy stocks? And so, because everybody's convinced for as long as stocks underperformed. And so now you've got not quite the reverse, but you almost have the converse of that, is that now everybody thinks stocks are, our generation's children are buying these meme stocks, and they're buying cryptos, and they're buying because they just see them go up. And anytime things go down, it's just a time to buy. Well, we agree that when things go down, it could be a time to buy, but your time horizon has to be long-term. It can't be this short-sighted. I'm shorting stocks. I have to pay back this thing. I got to limit my loss here. It's got to happen in a finite period of time.
Right. And I don't want, Chris, I don't want to make light of when markets go down, because it's very painful. And you and I experience it ourselves. I mean, we're just as human as our clients, and we're not super unemotional. We don't like watching it go down either, but we have to accept the fact that if we're going to accomplish what we're going to accomplish, these periods of time are very critical. As difficult as it is to watch, it's critical that they happen.
Yeah, we could say now, but in March of 2020, the pain that was there, we felt it, right? We felt it, and we felt the weight of really sorting through an unprecedented time to really sort through, okay, what are we doing for ourselves? Because we're invested, our 401ks are invested exactly like our clients.
Right.
So, this is affecting not just our clients, affecting us, and sorting through that and keeping the longer term, but not putting our head in the sand. Yeah, these are difficult things to get through.
We also believe that we have some of the best fund managers that we've ever had.
Right.
And we have some of the best diversification allocation of our indexes that we've had. And so, the biggest risk you have is of becoming emotionally attached to the downturn and then panicking and needing to get out. Because we saw that with 2 or 3 clients last year, and all 3 of those never were able to get back in the market, and they suffered permanent loss because of that.
From 2020, that's exactly right. And so for clients who are taking out withdrawals because they're retired and they're drawing on their assets to fill in for their household needs, we've been touting for a while that we've got the bonds on the sideline. We take from the bond side. We don't sell stocks when they're down, because that point you've got permanent loss. And so we take from the safer stuff. Bonds are down a little bit, but they're still there. They're down remarkably, markedly smaller and lower than what the stocks are down. It's lower degree, and so that just helps.
And the bond market is an interesting enigma in and of itself. Everyone's talking about inflation, and the bond market's sitting there saying, "Well, I'll take 2% interest for 30 years. Well, that economically is not logical if there was going to be 4 or 5% inflation on into the future forever and ever amen,
Right. And so you're still seeing, although short term, you're seeing prices are really still, are going up. By and large, though, when you compare today versus the 70s, it's not embedded yet in the psyche that, comprehensively across the nation, that inflation is going to be a long-term problem. Bond market doesn't think so, but bond market, as we've said, they may be more accurate than stock market people for predicting the future, but they may not have it right yet either. So, we have to be aware of that.
You've had a lot of supply chain disruptions. Even right now, China is currently in some ridiculous lockdown, like there's no tomorrow. You have still the ports out, especially in Los Angeles, their ability to receive goods and get them into the rest of the country is, I mean, without just, I don't know what they're even thinking about out there, I mean, that should have been rectified a long time ago. I mean, they should have put every thought process toward it because it's a major port in the country. And yet, it doesn't seem to be. And you want people to get back to trucking, to get back to the longshoremen, to get back to all these different things that move. But it seems like we just keep pushing them away and pushing them away. And so, between China and the moving the goods around the country, you got a problem. And until somebody corrects it, I know President Biden said he's going to put this task force. I'm wondering what the task force is doing, because
Yeah, so, but this is not unprecedented, and the type of it is, the cause of it is, but, many have pointed back to World War II when we came out of rationing, because we were putting things towards the war effort. Supplies were going towards that. They weren't ordinary things that people were using day to day were not available. So the war ends, and now there's this pent up demand. And it took 2 years for the normalization. You had inflation, go up significantly because demand outstripped supply. And so it took a couple of years for that to normalize. Interest rates did not go up during that time.
Yeah, it's fascinating. And anyway, our point is that we think it's going to be a volatile year.
Right.
It's just going to be that. It's going to be, if you've ever seen the classic picture of the bull head down, horns going up, and the bear claws coming down, that's what is happening right now. That classic picture where the bulls are saying, wait a minute, the US economy is still the greatest in the world, it's still going forward, and the bears are saying, no, we've got serious problems right now, and the market's probably going to come down, and we're going to take advantage of it when it does. And that's going to happen this year. That's going to be a bit of a fight with the Federal Reserve raising interest rates. They've already made it clear they're going to start raising interest rates.
That's right. Yep. That's a great picture, Drew.
But how much will they raise it? How bad will the market react? You got to remember, just 10 years ago, it was normal to have 3 or 4% interest rates on the short end. And our country did one of the greatest economic expansions ever in the history of our country. So little higher interest rates isn't the horrible thing. It's just how it comes into the economy and how, where it's like Warren Buffett said, when the tide goes out, you want to see who's swimming naked, and there's probably a handful of things going on in the economy that probably shouldn't happen.
Right. Yeah. So it's the speed with which these rates change that could really expose, as you said, some creaks in the system.
Right. Yeah. So we'll see. Anyway, we think we're positioned. We moved our bond duration down a little toward, expecting a little higher interest rates. We have our stock allocation in good places. We, hopefully all of our clients have good bond positions that we can draw on if they need cash.
Yep.
And those that don't, they're fully invested. So anyway, what else? We're going to get Mikey in here, right? We're going to
that's a market update for now. I'm going to let you two take the next leg onto the end. So it's been, we'll just continue to update on markets as we feel it's timely to do so.
You're the color man and I'm the straight
man. And whose storyline? That's what I want to know. All right.
All right. Let's talk to Mikey. So Michael, Chris and I were talking about investments, and you always like to have a good financial planning topic or two. Do you have any that you want to go over?
Absolutely.
We already talked about it. So
we did. We talked about it, and we talked about it on the radio show, which I guess will be about a week ago by the time this airs. But you wanted to talk about payments.
Yeah, there are numerous ways that when you go to a store or buy services from somebody to pay for them, okay? And what I learned many years ago, Mike, is that if you want to help to minimize your spending, you have to think about how you psychologically respond to each form of payment that you could use. Okay. So I could go to a store and I could pay cash, right? I can go to a store and I can use a debit card. I can use a credit card and I can use a check. And nowadays I can use Apple Pay, but that's really either connected to a bank account or to a credit card, right?
Right.
So those are your different ways of paying. But psychologically, we kind of put the brakes on one of those forms of payment because we're intimidated by it or whatever you want to call it. But the other one, we might freely just use it. And I use my example. When I don't know if you know what yours are, but when I was a kid, my father used to give us money when we'd go on vacation. What he would say to us is, here's $5. When you finish vacation, you have to spend it all. And if you don't, you got to give it back to me. And so guess what we did? We spent the $5 when we were on vacation. And ever since then, cash is in my pocket. It's meant to be spent. That's why I've got the cash in my pocket, is spend it. And so I tend not to carry hardly any cash because I spend it. And but I'm an accountant. And when I look at a ledger, I always like to see the bottom number in the ledger to be in the black, which means that I still have money in my checking account and so forth. I don't like
positive for the time period.
Right. I don't like seeing red. It's just, it's unpleasant to see a minus sign or brackets or red on my checking account.
And you go to great lengths to do that, don't you?
I do. So now every expenditure that I do, I use a credit card, but I enter every single transaction like that day into my checking account to know exactly where I stand, even with credit card purchases that I made that aren't going to be due to be paid for 30 days or so from now. And that focuses my attention on where I stand financially at all times. And spending will shut down. Ask my wife, she'll tell you. Spending will shut down if that ledger gets down anywhere close to the bottom and so forth. So that's mine. Mine is, debits and credits and seeing that, and cash goes out the door as quickly as it goes in my wallet.
Yeah. Well, and there's some other things we talked about related to this. And part of it is the fact that the reason you're using the credit card is the rewards. And, being mindful of what credit cards you have. The two sides of that conversation we were having is, on one side, it's, well, what is the reward? What is the highest cash back you can get? Making sure that when you use rewards, you're using them in the way that most benefits you. Drew told a story the other night of one of his cards, which lets him either have cash back or spend the money on Amazon, but he gets more cash back if he uses that option versus money they give him to spend on Amazon. Which
is contrary to what you would think, isn't it?
Right. Yeah, you'd think you're spending it the way they'd want you to, so it'd be incentivizing you to do it that way.
Yeah. Yeah. And, but on the other hand, some people like to fly and travel a lot. And so having a card that accumulates flight points might prove to be far more positive for that client than the cash back that I like. And if you spend a lot, like you use an Amazon credit card because it gives you lots of extra bonus points for Amazon because you're using their credit card.
So for my credit card story, there's two financial planning learning items. My wife and I have 3 credit cards. The American Express, which has our highest cash back, which we use anytime it's accepted. And then I have in my name a card that gives me free shipping from where I buy my clothes, and it's a Visa. So wherever American Express isn't taken, I use that. And then she has a card. What'd you say?
I bet you that's Orvis.
It is Orvis.
Because you're a duck hunter.
And then she has the Amazon card in her name, and that's where we use for all the Amazon purchases because it gives the highest cash back. But the other point there is that we both have a credit card in our name. So if something were to happen to me or to her, once the primary card holder is no longer alive, the card is dead. The card dies with you. So it's important when spouses, mix finances, that they each have a credit card in their name, also for credit building. And I think that was the main points around that. And then the other thing that I'll let you talk to everyone about is how having a mortgage can be an inflation hedge.
Well, debt is always an inflation hedge, okay? So you borrow money from somebody for 30 years, fixed at 3%, let's say right now, and inflation goes up to 4%, 5%, 6%. Let's just use those numbers. I'm not saying they're going there, but let's just use those numbers. That means every time I give that bank back $1, even after the interest I pay them, I'm saving money compared to the value of that dollar from the day I took that mortgage out, right? So,
and that's a fixed rate only.
It's got to be a fixed rate mortgage, okay? If it's not a fixed rate mortgage, it doesn't work. And it's got to be for a long period of time. So if my mortgage, if I took out a 5-year mortgage at 3%, yeah, it might help me for a little bit, but it doesn't help me a lot, okay? So you want to borrow money at the lowest interest rate you can for the longest period of time you can. And corporations have been doing this for years, Mike. Apple has like $100-some billion of cash on its balance sheet, but yet has $100-some billion of debt because people are lending it to them at like 1.5% for 10 years, or ridiculous interest rates. And so lots of corporations just are borrowing money because it's such a low interest rate despite the cash they have. So borrowing money for long periods of time on appreciating assets, especially like a house, because a house moves up in value during inflation, and you've got this ridiculously low interest rate, that's a benefit. And I'll give you a great example of this. Was my father, 1976, he moves to Pennsylvania. When he does, he buys a house. He takes out a $100,000 mortgage at about 4.5% or 5% at the time, 1976. 5 years later, money markets are yielding 15%, Mike, and the bank is writing my father letters. And I remember I was new in the business at that time, and my father shares with me that the bankers are asking me to pay off portions of my mortgage, and they'll give me a 10% discount to do it. What do you think? And I said, well, you're making 15% on your money. Why would you take a 10% discount on your mortgage when you're making 15% on your money? Right. So debt borrowed for long periods of time at low interest rates during inflation, extremely powerful thing.
And you would agree this is still nuanced. There's other things to consider. It's not that everyone should go take out,
No. I'm not saying that, because being debt-free is one of the greatest psychological things that the human psyche enjoys. So I don't want my clients to borrow money, but if you keep asking me, what are we going to do to protect against inflation? Debt used wisely at the lowest interest rate possible is an inflation hedge. But what if inflation doesn't come? And what if you take out this mortgage and the market doesn't go up a lot, and you've taken this mortgage out, you still owe the money on the mortgage, but you haven't made a lot of money on your money. So,
or the housing, prices.
The housing market doesn't do well for some reason,
But yes, from a pure standpoint, if you know you're going to have inflation, or you strongly suspect it, it's a great hedge.
If used wisely, and that's the key. And it's got to remain conservative, and it's got to remain in a way that you have full, firm control over when you can pay it off if you want to at any time, if necessary.
It's kind of like when we give clients advice about charitable gifting. The best way is charitable give highly appreciated assets. It's nuanced in the fact that if you were going to give anyway.
Yeah. Yeah. It says, oh, I'm going to get a tax deduction. Is that a good thing? No, it's if you are charitably inclined, then let's do it in the most efficient way possible. But if you aren't, your best to just keep your money, you know? So,
Well, I think we've set a world record on the longest Financial Pulse video.
hey, you know, they were good topics, Mike, you
Good
know?
topic, absolutely important time.
And we have tax season coming up, and we're looking forward to seeing everyone during that. Anyway, this is Drew Tignanelli saying God bless.